Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Now, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or any of the patterns and levels analysis or any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. There had been here in the past one dominant pattern over all this market that 26 weeks ago took a break on the downside. You can still see it in the top left corner of my daily chart. It was of course the late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it, but parts of the main pattern can still be seen. 29 weeks ago I laid out targets below for this pattern, with a primary target down at 226 and a secondary hardest reach target down at 194. 28 weeks ago prices reached the primary target, and after a lot of hesitation at the 200 level, prices 5 weeks ago reached the secondary target at 194. In early September, we saw the market trying to stabilize below 194 and right on the March 24 low at 187 3/4. However, last week had changeover and prices gapped higher, but only to the combination of the previously highlighted and important purple middle time, which is currently at 199 1/4 of the mid-March to mid-May bearish shift pitchfork, and at the same time the declining green short medium moving average, currently also 199 1/4. These have also so far capped the market, and though we are not as in other markets trying to fill in the changeover gap, we are at least seemingly getting capped by these, as well as congestion at 198.5 and the July 21 low at 197 1/4. Looking at this pitchfork, please be aware that there is no fallback. If this pattern is broken, then it cannot be finessed into another pattern. If it breaks, then that will be it. Thus, as I said 3 weeks ago, and I quote, "In all this, keep an eye throughout on the bearish mauve shift pitchfork, as it is the running the show right now." End of quote. So looking beyond the overhead combination, we have the common congestion at the early May lows in the 2020 area, and that's the price. And then the early July lows just under 204. But to me, at this time, the next significant resistances will be the flatlining medium moving average, currently 205. Meanwhile, below, well, we run into all sorts of congestion once the gap is filled from 193 1/4 down to 187 1/4, which is what we saw in early September. Beyond that, well, we don't seem to have anything that significant as support until the August low at the 176 1/4 area. Minneapolis wheat. The market in the past couple of weeks had been capped by the congestion at 578 3/4 and seemingly stabilizing over the newly realigned September 2019 to date dark blue uptrend, currently at 564 3/4, forming a lesser outside week last week. However, that with changeover, we had a significant gapping action higher, one that pushed up over the bright red neckline, currently at 590, of the very lopsided late May to mid-July head and shoulders top. Since the creation of this head and shoulders top, prices had a devil of an effort pushing lower, but they eventually did so in late July. I actually surmised 4 weeks ago that this holding on might be a function of the steep nature of the bright red neckline, and I still think that is true. Now, on this move down, I said 8 weeks ago, and I quote, "For a break low, we'd have a primary move below the neckline of 23.5 cents with a secondary harder to achieve move of 50 cents. End of quote. I quantified this for a primary target down in the 580 zone and a secondary harder to reach target X1 down in the 555 zone. And the primary target for this pattern was reached 3 weeks ago, and we were well on the way to the secondary target X1 before changeover and the gap higher. For now, I will keep target X1 at 555, still there, as I'm now carefully watching to see if the changeover gap between 572 to 586, will it be filled in? You see, as I said 3 weeks ago, and I quote, we're also possibly on the threshold of a really big pattern, a December 2024 today possible cat's ears pattern. This is a bearish pattern, but the discussion of this, which I've postponed for a couple of weeks, may be coming up and real soon, as we are about to trigger the downside opportunities for such a pattern. It's a long-term pattern, but I urge you to keep remembering this idea, as if we travel and stabilize at a lower than where we are, I may feel obliged to deploy it along with its ramifications. End of quote. And I still stand by this, and I watch the developments around the gapping action higher and whether there will be a subsequent filling in of it or not. London UK feed week. Okay, so there had been on this daily chart until early July and running for about a year, one major significant pattern here, a pattern that we have not seen in the other grain markets. I still have this on my daily chart for a reason, and the pattern is the bright red late May to early July 2024 bearish shift pitchfork. In early July, due to changeover, we had a very large gapping move higher, up and out of this pattern, beyond the bright red upper time, which is currently at 164.5. Please remember this level and also the bright red upper time, as it will show up again shortly. Now, added to this upper time, we had higher up the important, even today, 50% absolute Fibonacci line at 180.5. And you had to there, and even now, still have an area overhead that is significant resistance, as it capped the market on its rise back in July with some added nearby help at the time. From the purple July 23 to date downtrend, it's currently at 180.60. Now, since that peak, we've seen prices ease lower. 5 weeks ago, down below the gold long moving average, currently 169.20, and the 50% Fibonacci line of the May 24 to July 25 move at 169.70. And in recent weeks, moved below for the most part, below the May 23 low at 168. Plus, test down to the previously mentioned bright red upper time and below the very, very important dark blue neckline extension to a pair of long-term patterns, which I will detail now. Both these long-term patterns neckline are currently at 168.10. We really haven't stabilized below this key 168.10 level, but it is being seriously offered. This all leads to my final 4 points, the same 4 points I've been discussing for months now, and 3 of them were something that I noted back in my annual commentary back in January this year on London Feed Week. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that's their common neckline, highlighted in purple on my daily chart. My monthly chart, and that's currently 168.10, the same as on the daily chart I just spoke about. Thus, a primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, just below the bright red and big old 2005 to date uptrend, currently at 133. A secondary harder to reach target X4 will be down in the 112.85 zone, around where the shallow dark blue lower trend line is currently at 114 even, and that's for the 2007 to 2022 ascending expanding wedge pattern. For the head and shoulders top, we will have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts. The 1975 to date, yes, a half century old uptrend, currently at 65.95. I'm not even going to give you my secondary hard to achieve target for this pattern is below 0. Please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July with changeover threw a major spanner in the works for such a longer term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline, but it stopped at the 50% absolute Fibonacci line at 180.5. and just under the newly drawn 2023 to date upper bear channel line, which is currently 181.40. The question this posed, and it's a longer term question, is whether this was just a reactionary single month move higher or the beginning of something else. For now, I will continue to stick to the reactionary single month move higher, but I am prepared to start looking at the possibility of a new base of support, not only being built but also being exploited for a possible move higher. There is one caveat to this basing higher idea, and that is the one I've already mentioned, the newly drawn mid-23 to date big bear channel, currently 132.90 to 181.40. Even with such a big reactionary move back up, we are still sitting within this big bear channel, and it does have the advantage of already having had at least the minimum 5 touches necessary to legitimize it. For all this discussion, we are still dealing here with some very, very long-term patterns, and you should please bear that in mind. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.